Most people believe that if they ever need to deposit a large amount of cash, the smartest move is to keep the deposit just under $10,000. It sounds cautious. It sounds like the safe way to do it. And for years, that idea has been passed around as common sense advice between friends, neighbors, and even family members. But what many people, especially retirees, don't realize is that this exact habit can create the very problem they were trying to avoid. The moment someone starts splitting deposits into smaller amounts specifically to stay under that number, they can accidentally step into something federal law treats very seriously. And here's the frustrating part. The people who get caught up in this almost never have bad intentions. They aren't hiding illegal income. They aren't laundering money. They might have sold a truck they've owned for 15 years, received help from their children, or moved their own savings from one bank to another. Completely normal situations. The problem is that the banking system doesn't see the life story behind the cash. It sees patterns, amounts, timing, and frequency. And certain patterns create signals that trigger questions. So in this video, I'm going to walk you through exactly how the rule works, why the stay under $10,000 strategy backfires, and what to do instead. Later, I'll also share the story of a retired teacher who ran into this issue while simply trying to get her finances organized after losing her husband, because it shows how easily this can happen to someone who has done everything right. Welcome back to US Policy Brief. I'm Michael, and I spend a lot of time researching the rules and banking practices that tend to catch ordinary people off guard. Not because the rules are hidden, but because the way they work in real life is often very different from what people hear through word of mouth. Over time, certain financial tips spread fast, especially in retirement communities. Someone hears something from a neighbor. That neighbor heard it from someone at a bank years ago, and before long, it becomes a rule everyone repeats as fact. The $10,000 bank deposit rule is one of the biggest examples of that. In this video, I'm going to explain what the rule actually is, what banks are required to report, and why the report itself usually isn't the issue. Then, we'll walk through the three most common situations where retirees stumble into problems: selling something for cash, receiving money from family, and moving their own savings between accounts. Along the way, I'll show you the simple paperwork that protects you if questions ever come up later. Once you understand what the system is truly looking for, the solution is surprisingly simple, and it's usually the opposite of what people have been told for years. To understand why this topic causes so much confusion, you first need to understand what the $10,000 threshold really means. Banks in the United States are required by federal law to file a currency transaction report, CTR, when a customer deposits more than $10,000 in cash. The key word is cash, physical bills, not checks, not wires, not electronic transfers. When more than $10,000 in cash comes in, the bank files the CTR routinely. They don't ask you for permission. They don't call you first. In many cases, the customer never even knows it happened. It's simply a required record that goes into a large database used to track major cash movement in the financial system. And this is important. A CTR is not an accusation. It doesn't automatically mean the government thinks you did something wrong. It does not automatically trigger an investigation. Millions of CTRs are filed each year, and most never lead to any follow-up. Think of it more like a standardized receipt that the system keeps, not a warning label placed on you. The confusion begins because people hear, "The bank reports deposits over $10,000. And then they assume the smartest move is to avoid that report. That's where the common advice comes in. Deposit $9,500 today and the rest next week. Split it between accounts, have your spouse deposit part at another branch, keep each deposit under the limit." It sounds like a harmless workaround, but federal law anticipated exactly that behavior, because it's the same tactic used historically to move large amounts of cash through banks without triggering reports. Intentionally dividing cash transactions to avoid the CTR threshold has a name: structuring. And structuring is treated as a serious federal offense. This is where the irony becomes painful. A person can work honestly for decades, save carefully, do everything right, and then follow well-meaning advice about staying under $10,000, only to create a pattern that looks suspicious to automated bank monitoring systems. Modern banking software is built to detect patterns, not personal character. It doesn't know you're a retiree. It doesn't know you sold a truck. It doesn't know your child gave you money for a roof repair. It sees repeated deposits that cluster just under the reporting threshold, and that pattern can trigger internal review and reporting. That's why this matters. Not because depositing cash is wrong, but because misunderstanding the rule leads people to make choices that create unnecessary problems. Now, let's talk about how this shows up in real life, because there are three situations where retirees run into this again and again. The first is when someone sells something for cash. This happens more than many people realize. Maybe you sell a pickup truck you no longer need. Maybe it's a boat, an RV, a piece of equipment, or a classic car you've held onto for years. Private sales often happen in cash because buyers want a quick, uncomplicated transaction. So imagine you sell a vehicle for $11,000 in cash. That is completely legitimate. You sign the title, the buyer pays, and you go to the bank. If you deposit the full $11,000 in one transaction, the bank files a CTR. That's all. No drama. No automatic trouble. The bank employee may not even mention it because it's routine. But here's where the problems start. You mention it to a neighbor, and they say, you shouldn't deposit it all at once. Keep it under $10,000 so the bank doesn't report it. That idea gets repeated constantly. Sometimes people say $9,900, sometimes $9,500 just to be safe. The numbers change, but the concept stays the same. Stay under the limit. So next time, instead of depositing the full amount, you split it. $8,000 today, $3,000 next week. It feels organized and careful. But from the bank's perspective, it can look like you deliberately structured the deposits to avoid reporting. The safest and simplest approach is usually the opposite. If you received $11,000 from selling a vehicle, deposit the full $11,000 at once. Let the CTR happen. What protects you is the documentation, a bill of sale with the buyer's name and purchase price, the title transfer, and your deposit receipt. Those records tell the story cleanly if anyone ever asks, which is rare. The second common situation involves family help. This one comes from good intentions. Adult children often help parents with medical expenses, home repairs, or unexpected costs. A son might say, I want to give you $15,000 to help with the roof. A daughter might help cover medical bills. These gifts are common, legal, and usually not taxable income to the parent receiving them. But once again, confusion starts when the family tries to avoid hassle. Someone says, I'll give it to you in smaller amounts so the bank doesn't report it. Or deposit some now and some later. Or put half in one account and half in another. People think they're doing the responsible thing. The cleanest approach is to transfer the amount normally in one transaction. If it's done by check or wire, there's already a built-in paper trail. If it's given in cash, depositing the full amount at once is still usually cleaner than splitting it into repeated under $10,000 deposits. And you can protect yourself with an extremely simple document, a short, signed gift letter stating the amount and the date. It doesn't need a notary, and it doesn't need complicated legal language. Combined with your bank deposit receipt, it creates a clear explanation you can keep in your records. The third situation surprises people the most, because it's not money from a sale and not money from family. It's your own money moving between your own accounts. And this is where many retirees accidentally create the kind of pattern that sets off alarms. I want to share a story that illustrates this. A retired teacher, 69 years old, recently widowed, was trying to simplify her finances after her husband passed. Like many long-married couples, they had accounts in different places. An older bank account from years ago, another account opened later, a CD that had rolled over multiple times. Nothing complicated financially, but emotionally overwhelming. She decided to consolidate everything into one bank to make her life easier. That's normal and often recommended. But instead of moving the funds in one clean transaction, she moved them gradually over several weeks. $9,000 one week, $8,000 the next, then another amount just below $10,000 a few days later. She wasn't trying to hide anything. She wasn't thinking about the rule at all. She simply thought smaller transfers would be easier while she was already drowning in paperwork and grief. Several weeks later, she received a letter asking her to explain the transaction pattern. That kind of letter can feel terrifying when you've done nothing wrong, especially for someone already under stress. In most cases, once an explanation is provided, the situation ends. But the emotional shock is real. And it happened for one reason. Automated systems don't know context. The system didn't know she was widowed. It didn't know she was a teacher. It didn't know she was reorganizing her own savings. It saw multiple transactions clustered just under $10,000, and that pattern resembles structuring. The lesson is simple. Moving your own money between your own accounts is legal and common. The issue is not the transfer, it's the pattern. When you need to move a large amount, the cleanest method is usually one transaction, such as a wire transfer or a cashier's check, with a clear record showing source and destination. And the documentation you keep is easy. The original account statement showing the balance, the wire confirmation or cashier's check receipt, and any CD maturity notice if that's the source. Those documents create a clear timeline that explains everything without you having to talk your way out of confusion later. This brings us to the most important mindset shift. What protects you is not avoiding reports. What protects you is having a clear paper trail. Once you understand that, the $10,000 number becomes less scary because your focus moves to the real solution: documentation and clean transactions. There are 5 simple records that make explanations easy if questions ever arise. First, keep a document showing why the cash exists: a bill of sale, a gift letter, or a transfer record. Second, keep a bank statement showing where the money was before it moved. Third, keep confirmation of the transaction itself, like a deposit receipt, wire receipt, or cashier's check stub. Fourth, make sure your tax records align with the transaction when the transaction is something that belongs on a tax return. Fifth, if anyone asks questions, respond once, clearly, with supporting documents, without over-explaining or adding extra details that weren't requested. If anything becomes complicated, that's when you talk to a CPA or attorney. Now, let's quickly clear up a few myths that cause constant confusion. The first myth is that depositing $9,900 is safe. In reality, repeated deposits just under $10,000 are among the most commonly flagged patterns because they look deliberate. The second myth is that only criminals ever get asked questions. Automated monitoring flags patterns, not personalities, and honest people can get caught in routine reviews. The third myth is that retirees are somehow exempt. There is no retirement exemption. A 72-year-old depositing cash is treated the same way as anyone else. When you strip away the rumors, the real rule is straightforward. The system was designed to track major cash movement to detect serious crime, not to trap retirees handling normal life transactions. If you deposit more than $10,000 in cash, the bank files a CTR, and in most cases, nothing else happens. The problems usually come when people try to avoid that reporting by splitting deposits into smaller pieces. So if there's one takeaway, it's this: don't break up deposits just to stay under $10,000. That behavior creates the pattern the system is built to detect. Instead, deposit legitimate money normally and keep simple records that show where it came from. In practical terms, that means 3 habits. 1. Deposit legitimate cash in full rather than splitting it. 2. Keep basic documentation like bills of sale, gift letters, and transfer receipts. 3. If you're moving your own savings, do it in a clean single transaction when possible and save the confirmation. Most people who run into issues here didn't intend to do anything wrong. They were given advice that sounded helpful, but was backward. Transparency and documentation are what keep things simple. If you're comfortable sharing, comment with your state and the situation you deal with most: cash sales, family gifts, or moving savings, because I read the comments and it helps me decide what to cover next. Thanks for watching US Policy Brief. I'm Michael, and I'll see you in the next video.